Investing in the stock market can seem like a daunting endeavor, especially for beginners. The sheer volume of information and the complexity of financial terms can be overwhelming. It's a world filled with complex jargon, fluctuating numbers, and seemingly unpredictable outcomes. Terms like bull market, bear market, dividends, and capital gains can sound like a foreign language. But don't let that intimidate you. Every seasoned investor started where you are now, and with the right guidance, you can navigate this world with confidence. At its core, investing in stocks is about participating in the growth of companies and, in turn, growing your wealth over time. When you buy a stock, you're essentially buying a small piece of a company. This guide is designed to demystify the world of stock investing for beginners, providing you with the foundational knowledge and practical tips to get started on your investment journey. We'll break down complex concepts into easy-to-understand terms. This guide will walk you through the basics of stocks, from understanding what they are to exploring different types of stocks. You'll learn about common stocks, preferred stocks, and the differences between them. You will learn about the benefits of long-term investing and discover strategies that can help you make informed investment decisions. We'll discuss the importance of diversification and how to build a balanced portfolio. Whether you're starting with a small amount or have a larger sum to invest, the key is to start early and remain patient. Even small, consistent investments can grow significantly over time due to the power of compounding. Remember, investing is a marathon, not a sprint. It's about setting long-term goals and staying the course, even when the market experiences volatility. The goal of this guide is to empower you to take control of your financial future. By understanding the basics and developing a solid investment strategy, you can make informed decisions that align with your financial goals. By the end of this journey, you'll have a better understanding of how the stock market works, the potential it holds for wealth creation, and the confidence to start investing wisely. You'll be equipped with the knowledge to analyze stocks and make decisions based on your financial objectives. Remember, every expert investor was once a beginner. They learned through experience, education, and sometimes trial and error. With the right knowledge and approach, you can navigate the world of stocks and pave your way to financial success. It's about being diligent, staying informed, and continuously learning. Let's begin our journey into the exciting world of stock investing. Together, we'll explore the opportunities and challenges, and you'll gain the confidence to make your first investment with a clear understanding of the path ahead. In simplest terms, a stock represents a small piece of ownership in a publicly traded company. This means that when you own a stock, you own a fraction of the company's assets and earnings. When you buy a stock, you are essentially buying a tiny slice of that company, making you a shareholder. As a shareholder, you have a claim to part of the company's profits and assets. Companies issue stocks to raise capital for various purposes, such as funding expansion, research and development, or paying off debts. This capital is crucial for the company's growth and operational efficiency. The price of a stock is determined by supply and demand. This dynamic is influenced by various factors, including company performance, investor sentiment, and broader economic conditions. When more people want to buy a stock than sell it, the price goes up. This is often driven by positive news about the company or favorable market conditions. Conversely, if more people are selling than buying, the price goes down. Negative news, poor financial performance, or economic downturns can lead to a decrease in stock prices. This constant fluctuation in prices is what makes the stock market exciting and potentially profitable. Investors are always on the lookout for opportunities to buy low and sell high. When you buy a stock, you're essentially betting on the future success of that company. Your investment is a vote of confidence in the company's potential to grow and succeed. If the company performs well, its value increases, and so does the value of your stock. This can lead to significant financial gains for investors who choose wisely. You can then choose to sell your stock at a higher price than you bought it for, making a profit. This process of buying and selling is the essence of stock trading. However, if the company doesn't perform well, its stock price may fall, and you could lose money. Investing in stocks always carries a risk, and it's important to be aware of this. Understanding the basics of how stocks work is the first step towards becoming a successful investor. Knowledge is power, and the more you know, the better your investment decisions will be. As you delve deeper into the world of stock investing, you'll encounter various terms and concepts. These include dividends, market capitalization, and price-to-earnings ratios, among others. Don't be afraid to ask questions, research, and learn at your own pace. The stock market can be complex, but with patience and persistence, you can master it. Remember, every bit of knowledge you gain brings you one step closer to making informed investment decisions. Continuous learning and staying updated with market trends are key to long-term success in stock investing. Not all stocks are created equal. Each type of stock has its own unique set of characteristics, risks, and potential rewards, making it essential for investors to understand these differences. There are different types of stocks, each with its own characteristics, risks, and potential rewards. Knowing these distinctions can help you make more informed investment decisions and tailor your portfolio to meet your specific financial goals. Understanding these differences is crucial for building a diversified and balanced portfolio that aligns with your investment goals. A well-diversified portfolio can help mitigate risks and take advantage of various market opportunities. One of the most common types is common stock. Common stocks are what most people think of when they hear the term stocks. When people talk about stocks, they are usually referring to common stock. Common stockholders have the potential to earn dividends and benefit from capital appreciation if the company's stock price increases. As a common stockholder, you have voting rights in company decisions and are entitled to a share of the company's profits in the form of dividends, if the company chooses to pay them. This gives you a voice in the company's future and a potential share in its success. Another type is preferred stock. Preferred stocks are often seen as a hybrid between common stocks and bonds. Preferred stockholders have priority over common stockholders when it comes to receiving dividends and company assets in case of liquidation. This means they are paid out before common stockholders if the company goes bankrupt. However, they usually have limited or no voting rights. This trade-off is often acceptable to investors who prioritize steady income over having a say in company decisions. Preferred stocks are generally considered less risky than common stocks, but also offer lower potential returns. They provide a more predictable income stream, which can be appealing to conservative investors. Beyond these two main types, stocks can also be categorized based on the company's size, industry, and growth potential. These categories help investors understand the different risk and return profiles of various stocks. There are large cap stocks, which represent large and well-established companies. These companies are typically leaders in their industries and have a history of stable earnings and dividends. Small cap stocks, which are from smaller emerging companies, often offer higher growth potential but come with higher risk. These companies may be more volatile and less established. And mid-cap stocks, which fall somewhere in between. They offer a balance of growth potential and stability, making them an attractive option for many investors. Understanding the different types of stocks and their characteristics is crucial for making informed investment decisions. By knowing the strengths and weaknesses of each type, you can better align your investments with your financial goals and risk tolerance. By diversifying your portfolio across different stock types, you can spread your risk and potentially enhance your returns. Diversification helps protect your investments from market volatility and can lead to more consistent performance over time. Stock market investing is not about getting rich quick schemes. It's about participating in the long-term growth of companies and benefiting from their success over time. This is where the concept of long-term investing comes in. Long-term investing involves holding on to your investments for an extended period, typically 5 years or more, rather than trying to time the market for quick profits. While it might be tempting to buy and sell stocks frequently in pursuit of short-term gains, history has shown that patience and a long-term perspective often lead to more substantial and sustainable returns. One of the main advantages of long-term investing is the power of compounding. When you reinvest your earnings, your money starts working harder for you. Over time, even small amounts of money can grow significantly through the magic of compounding. Moreover, long-term investing allows you to ride out the inevitable ups and downs of the stock market. Stock prices can be volatile in the short term, influenced by various factors such as news events, economic data, and investor sentiment. However, over the long term, these fluctuations tend to even out, and the overall trend of the market has historically been upward.